Welcome to CRT 5 a.m. Model Full Forex Course Introduction class, right? So, welcome everyone who are joining this course, right? This introduction class, we will talk about what you're going to learn in this course, right? If this course is for you, if it is not for you, the essential for start, right? The necessary tools like platforms and time frames and whatever you're gonna need for this course, right? We're gonna talk as chart configuration as well, so we can align all the charts and do the correct way because time is very important, okay? And in this course, you will learn from A to Z how to become a successful trader using the 5 a.m. model to Forex, right? So before all right, guys, just quick reminders here, okay, before we continue to this full course, right? The first reminder here is the Discord link is in description. So if you want to join the community, it's all free to join the community, okay? And have a lot of like-minded people, and we can help each other there, right? So Discord link is in description, right? Just click and join, right? Second reminder here is the order flow channel is linked below also. So I noticed that a lot of guys have interested in order flow content for futures. So maybe in the next months I will be working more in the order flow channel. I don't know yet, but possibly. So if you want to have some content about order flow, just go to the channel, subscribe there, uh, hit the bell, right? And then you get notice when you have more order flow videos. We have some videos there, I guess 2 or 3 videos about order flow. You can check and all free, of course, right? So order flow, if you are interested about order flow, just go to the order flow channel and subscribe, right? Another quick reminder here, spots on the mentorship are available. So if you want to join the one-on-one mentorship, right? And I wrote it wrong here, whatever. So if you want to join the mentorship, okay, I still have spots available. The price it's pretty doable, okay, pretty like for any one of you guys can participate and improve your trading results. A lot of guys haven't participated and improve their trade results. The pictures are in this Discord and anyway, so if you want to join the mentorship, we still have spots available. Okay, you can join the Discord, call me in the direct. I will answer all your doubts. Okay, and then we can work in something special and unique for your case, right? Plus of that, we have the live room daily going on Discord. So if you have interested to trade forex and Nasdaq with me, okay, you can go to the Discord, check the links, and join the live room, right? And of course, no less important of all this, like and subscribe this video because it's all for free, guys. And we have here a huge, you know, course and content all for free, right? So your way to pay me is like, subscribe, comment something, right? Anything that your heart tells to comment. So there's that. Okay, let's go to the content, guys. Thank you. Let's start. What you're gonna learn in this course, okay? And what you're gonna learn the 5 a.m. model. Oh, this looks like an S, like the 5 a.m. model. Okay, that's what you're gonna learn in this course. And why is the 5 a.m. model? Because anyway, I don't go so deep right now in this introduction, but we will trade the 5 a.m. time window. Okay, so we're going to trade 5 a.m. time window. This is the basic premise of this course. Okay, is you're going to have your time window to trade, okay, and then we're going to trade only this time window, and I want you guys to be perfect to execute this, because if you execute this perfectly every day without missing, you will be profitable, and this I can promise you. Okay, So this is what you're gonna learn in this course, right? And if this course is for you, I don't know. First thing, you trade Forex, right? So if you trade Forex, this course is for you, okay? If you want to trade Forex, this course is for you. If you don't want to trade Forex, if you want to trade futures, if you want to trade gold, if you want to trade anything else, this course isn't for you. This course is specifically for Forex, okay? And which leads me to both assets we're going to trade, okay? And this is important to tell you now for you guys don't keeping me ask me later. And we're going to trade Euro, USD, okay? And we trade GBP, USD, okay? These are going to be the both asset class that we're going to trade in this 5 a.m. model, okay? We don't want to trade gold. We don't want to trade like dollar yen or CAD or Swiss franc or whatever shit, okay? You don't trade the 5 a.m. model because the 5 a.m. model it's a specific time window for this both assets here, okay? So this is going to be the both assets that we going to trade in this course, right? So the tools that you're gonna need, okay, obviously you're going to need um, a trading account, okay, that's trading. I'm gonna put trading account like this, and if you don't have a trading account, just go to the link of the description and you can get the best trading account to this model, that is the Fivers, okay? So the link is in description. It's just click there and get your trading account, right? The second thing is you're going to need your trading view. That's what I'm using here, okay? So if you're not use trading view, go to internet and type trading view and you're going to land this page right here, okay? And you're going to use trading view for do all your analysis, okay? The third thing is the MetaTrader 5, okay? And a lot of people don't like the MetaTrader 5, but I personally do because this platform is phenomenal, right? Because we don't have any problems of this platform. We don't have any bugs or something like this. And you can use the position sizer, okay? This is very, very important for us, okay? The position sizer um, you can abilitate in your trading account, right? And the MetaTrader 5, it's a platform that it's allowed by the Fivers, right? So once you get your Fivers account, you're going to log in the MetaTrader 5 platform for execute your trades. So what you're going to do, you're going to analyze here on TradingView, right? And just open the MetaTrader 5, sorry, for set your orders, okay? You're going to do all the analysis right here on the TradingView and then go to MetaTrader 5 and just place your orders, right? With the position side. That's very important, right? Um, and of course, you're going to need your YouTube for watching those videos, and you're going to need the Discord, okay? Because the Discord community is awesome, okay? So you can join. It's free to join, right? And the link is in the description. And you're really going to need the Discord for support. And you have any doubts, you can ask me there, okay? That's totally fine. Um, anyway, basic tools, I do believe is this, okay? You don't need more tools than this, right? So let me erase this, right? And we talk about the assets. Let's talk about time frame. Okay, so time frame that we're going to use, okay, is New York time frame. I don't know where are you looking this video, which part of the world you're looking at this video, okay, but each part has a different time zone, okay, and we going to use the New York time zone, okay, the United States time zone, because it's in this time zone that shit happens, okay? Uh, and it's this real time zone that the real money comes in, okay? So to do so, we're going to lock in the New York time zone. You go here to your MetaTrader, oh, your trading view, sorry. You come here to your trading view, right in the right down below here, okay, and click in this time zone, okay, and then you go to New York UTC -5, okay. You set here your time zone for New York time zone, okay. You just ignore the rest of this, okay. Just set UTC -5 New York time zone, okay, and then you should set to go. So your chart is going to show you as a New York time zone, okay. That's really, really, really important. So after we do this initial configurations, okay, you should be using right now the trading view, the Fiverr's prop firm account, because you're going to pass a prop firm account using this content, and I can promise you that, right? If you done correctly in everything I said, you will pass a lot of founded accounts. So use the Fiverr's for that. It's the best scaling plan there is in the market today, right? And so you should be set with your trading account, right? With your trading view account and your Discord community, right? So this should be all that you need for trading, right? And of course, let's set some expectations here, because trading isn't a business that happens overnight. Okay, me personally, I'm 90 years of in the trading business. Okay, so it took me a long time to learn properly what I have to do and what I need to do. And my worst enemy, like I can say for sure, my worst enemy was myself all the time. Okay, so once I learned to control myself and learn how to deal with my demons, I became profitable with the right strategy, right? And this is what I going to teach you in this series of videos in this full forex course. Okay, I will teach you how to truly dominate a strategy and to dominate your demons as well, for you to become the most profitable trader that you'll ever become, right? So, but to do so, this is not going to happen overnight, okay? That needs to take you a lot and a lot hours of studying and annotations, and dedicate yourself, like really dedicate yourself. But I highly suggest you do, because this content that I'm going to show you in this course has the power to change completely your life, like did to my life. So I highly recommend you to pay attention and take notes and really learn this, because it's a very powerful content. Okay, but needs to be patient. Doesn't happen overnight. Needs to a lot of effort. Okay, and stop and blame another people for your mistakes. Okay, it's time to grow up and accept this whole time it is your fault. Okay, it is your fault because you done things the wrong way. It's not your fault because you don't find this content. Okay, because you just find crappy content on the internet. This is not your fault. Okay, but your behavior in front of the charts, this is your fault. So we're going to correct this. Okay, and for correct this, I need you guys to trust me as your mentor, okay, and have a full, trust in me in this sense, because I know what I'm talking about, because I've been through all those stages, right? So if you really trust me and accept me as your mentor for this journey to become profitable, comment down here, I trust you, Skype, and I will read all the people who came to here, right? So this is the end of the introduction class. In today's lesson, we're gonna talk about CRT. Okay, what is CRT? Okay, the main idea about CRT, right? Why it works, how to identify the CRT, right? The reading of a CRT correctly. Okay, the candles in the CRT we're gonna talk about, the reaction of the price in the range of the CRT, when to apply CRT, and when to seek for entries. Okay, so we talk about these 8 topics in this video, right? So before anything, I will gently ask you to drop your like in this video and drop your comment, okay? Because this is very important. This is your way to pay me back, okay? And don't forget to join our Discord community, right? It's free to join. The link is in the description, and then you can find a ton of quality content about CRT and SRT. Okay, so no further ado, let's begin with lesson 2. Okay, so the main idea of the CRT, right? What is CRT? CRT is candle range theory. Okay, this is what it means, CRT. So if you take a close look, you see that you have a range right here. This is the most important part of CRT. This R right here. Okay, because everything CRT is, it's you're going to see candles, right? Candles. But inside of these candles, we have ranges, right? Because price, so as time is fractal, right? So every candle has a range inside. And this is basically all CRT is about. It's about ranges inside of the candles. The candle, it's another way to see a range. Okay, can be a time range or it can be a price range. We'll talk about this later. Okay, but the main fact here is you need to focus here in the range. This is the most important part of CRT is the range. Okay, because you're going to see ranges inside of candles, right? This is pretty basics, right? Um, like this candle here. Okay, let's say this is a bullish candle. Okay, so you have here opening, probably a low. You're going to have a high until here, down, and a close. Okay, so this it's going to be your range. So your price can move from here and come here and come here and do all those things and end up here, right? So this it's what this candle means, right? That you have an opening, you have a low, you have a high, and you have a close. In each candle, you're going to have a footprint of your range, right? So pay attention to this because this is very basic, but it's very important for you guys to know, right? And why this works actually, because in this candles and this candles range, right? You can see your range obviously, but what do you do in range extremities, like in the range high and in the range low? What do you have here? You have liquidity, and liquidity is the fuel of the market. Okay, we're going in depth into liquidity in few lessons from now, but all you need to do and you need to know from here, it's when you have, let's say we've had like this, the range of this, okay, you have liquidity points. Oh, sorry. What the fuck? What I just did. Right. So let's draw it again. Okay. You have liquidity points right here. You have liquidity points right here. Okay, of course you have liquidities internals here, but we're not talking about this right now in this video. But you need to focus on the liquidity, okay? Because you have liquidity, and liquidity is the fuel of the market. The market moves only because there is liquidity, and the price, it's no question going from where is liquidity, right? So if you have liquidity right here, this is a magnet from price. If you have liquidity right here, it works like a magnet here and here and here, right? So this is why candle range theory, it works, because it simplifies the way to see the liquidity, right? So let's see how we can read a candle in the charts, right? So I grab this example here. You can pick any candle that you want, okay? But I will grab this example right here because this is a valid CRT that we're going to talk about, right? But if you took a closer look in this particular candle, you can do it with every candle that you see, okay? Because every candle has a range, right? So if you take a closer look, let's say we are in the daily time frame, okay? So in the daily time frame, all you see is a candle, right? But if we drop down this for 1 hour, you're going to see there is a range inside here, right? And the range is probably here. You open, right? And then you have a low, you have a high, down, and you have close, right? And that's exactly what is printed in this candle, okay? You have an opening, you have a low, you have a high, and you have a close, right? See how pattern repeats itself? Pretty easy, right? We can see the range better if we go into the 50-minute perhaps, right? So here, what we have here. Opening, low, high, and close, right? So you can see then in each candle, there's a range inside. And inside of this range, what do you have? You have liquidity, right? This is important for us. Here, you have liquidity. This is important for us. Okay, so I need you to pay attention to this because this is very, very, very important on candle range theory. Okay, so now we're going to talk about when to look for a valid CRT itself, right? And when to not look for a CRT, right? So in the CRT cases, like valid CRTs, not talk about regions right now, we'll talk this a little bit later, right? But once you're gonna look for CRT, what you wanna see is a strong candle like this. Heavy candle, can be bearish, can be bullish. It will depends on what you're looking at. Like if you are in a high, probably this candle will be bullish. Okay, if you are in a low, probably this candle will be bearish, be a negative candle, and the high is a positive candle. So you want this type of candle, this strong candle right here, okay, to be formed. We don't want to work with candles like this, and this, Okay, this this type of candle, this type of candle, this type of candle. We don't want to work with this. Okay, we want to work in this type of candle, this type of candle right here. Okay, this type of candle. You want to have strong candles like this, not candles like weak candles, small candles like this. This don't show us nothing. They'll show the intention of the price. Okay, so once you have your candle marked, okay, but you probably wondering yourself, okay, I know how to mark candles. I know candles are ranges, right? So when and where I'm gonna mark these candles, right? Because okay, I know to seek for a strong candle, and I know in this candle we have ranges inside and we have liquidities. In the extremities and the inside of this candle we have liquidities. Okay, but when I'm going to look for valid CRT, okay, a valid candle that you can actually trade, like this candle. And this is a major thing. That's a really important thing. Okay, so pay attention. You want to look these candles within a key level, right? And we're going to have a lesson specifically about key levels, right? But key level is nothing more than liquidity points. Okay, so you're going to align the liquidity points with your candle, right? So like this, you have this candle right here, and you have a key level. Okay, you have a strong liquidity point right here. Okay, so you have a key level right here. Okay, key level. You have your CRT. Okay, candle range high, and your candle range low right here. Okay, and if this candle, we purge this liquidity of this key level. That's what's validate the CRT. Okay, so like this, in this case, okay, you have a strong candle, but you have no key levels. You have no key levels. Here you have no highs or no FGs have been taken. Not any lows has been taken. So you have no key levels. Same as this. You have a strong candle, but you don't have nothing here. Okay, you have absolutely nothing from here. Like this as well. You have a strong candle, but you have no key level, right? And this is what the CRT is about. You need to align your strong candle with your valid key level. Once you do that, you have your valid CRT entry, right? And how and when I'm going to enter this, okay? First thing you want to notice is the candle number 1 right here, okay? It's your, let's say, your validation candle, okay? Because if you don't have this strong candle with the key level, it doesn't mean anything, right? The second candle right here, it's your, what the fuck? It's your confirmation candle, right? This candle here is your confirmation candle because this candle purged your CRT high, your candle range high, and purged the liquidity of the key level, right? And this candle must close inside of your range. If this candle close above, close outside right here, you disconsider, okay? And then your entry, it's in the candle number 3, right? That is the distribution candle. In this particular example, it's not that clear to see the distribution candle, right? Because this distribution candle took a little longer to distribute but most of the times the distribution candles is gonna be heavy candles, right? It's gonna be strong candles, because what basically do we have in this CRT way of trading is the PO3. Okay, and I know you guys know the PO3. Okay, so we have the accumulation, and then we have the manipulation, and then we have the distribution. Okay, so all this is about, the candles are the phases. Okay, so we have in the CRT is the same thing as the PO3. Okay, you're going to have phases. In each candle represents one phase. So candle number one represents phase number one, that is accumulation phase, right? So you are accumulating near an important liquidity point, right? Candle number two is the manipulation phase, okay? So you're going to manipulate the accumulation and your liquidity point, that that is a key level, right? And then you have your candle number three. This guy is the distribution candle, okay? The price is going to distribute all the contracts they grab from here until here. Okay, so this is basically what CRT is about. CRT is just another way to see the power of three in the markets. You have the accumulation, the manipulation, and the distribution. Okay, it's all about, as you want to call, turtle soup, manipulation, liquidity grab, fake out. It's all the same thing, PO3. Okay, is the accumulation of contracts, manipulation, get stopped right here, and then distribute the price to make profit. Okay, so I want you guys to take your charts, okay, go to high time frame key levels like 4 hour, 1 hour, daily, weekly, monthly, and try to find CRTs. Okay, try to find valid candles, valid manipulations, and valid distributions. Okay, and your entry is going to always be in the candle tree. We not talk about entry models right now because it's not the point of this video. The point of this video is talk about CRT and how it's formed and how you can use it. But your entry is going to be in this distribution candle because it's the safest way to enter and it's the easiest and the fastest way to get your reward, right? For some more advanced students, we can grab second candle entries, okay? But it's more, really, really more advanced, okay? You should focus on candle number three entry, right? In this class, we're gonna talk about ICT essentials, right? Everything you need to know about ICT. I'm gonna spare you a lots of hours of content of ICT. Okay, so I can to teach you what exactly you're gonna need and not a lot of nonsense and bullshit, right? So we're gonna dive deep to this to we can align, everyone's knowledge, right? So we need to have a base, and this ICT essential, it's a solid base, so it's important to us all know what this is about, right? So you can call it SMC essentials if you don't want to use ICT as well, but quite the same thing, right? So before we dive into the content itself, okay, I want to remind you the like button is for free, so make sure you hit this like button. All right, don't forget to subscribe to the channel, that's very important, right? Plus we have a Discord community that's totally for free. You can join by link in the description, right? And there we have a live room every day and a swing trade room, and you have a 3-day free trial. Okay, so you can enter in Discord, enter in the community, and enjoy the Discord and get yourself the 3-day free trial if it's worth for you, right? So you can test the rooms And if it makes sense, you can continue. It's going to be great for you and your advance. All right. So we're going to talk about a lot of topics here, but we're going to start with the most easiest, right? And going for the most complex one, right? So the first topic we're going to talk about here is this one you guys probably know about. It's BOSS, or if you're not familiar with it, it's break of structure. Okay, so what this exactly means? Okay, so BOSS, or break of structure. Okay, we're gonna dive into more deeply in structures, right? But basically, when you have a structure, okay, and I will make this black, okay, you have a market structure like this, okay. Every time you break a high or break a low in a continuation sense, okay, not in a reversal sense, in a continuation, like here, and then come here and break it, like you come in high, you correct, and then come high again. This here is your break of structure, okay. That means break of structure, it always indicate a continuation of the trend or continuation of the flux, right? Of the flow of the charts. So break of structure, aka BOSS, it's a continuation sign, okay? Every time you had a BOSS like here, it means the price is getting higher and higher, or in this case right here, lower and lower, okay? You can see the BOSS by this line here once we break the highs or we break the lows right here. So I'm gonna paint this as a red line, okay? Red lines right here. This is the BOSS, right? Or you can observe as well, if you want to have more confluences to your continuation, you can see here, right? What this means. You have higher lows and higher highs. Okay, so low, high, higher low, higher high, higher low, higher high, right? So you see the trend. Okay, same case here. You get this high, high, high. You get this low, 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 low. You have a low, you have a high. You have a lower low, lower high, lower low, lower high, lower low, and so on. Okay, so BOSS, it means continuation, right? And for the continuation, in the other side, you have what? Oh, sorry. You have what in the other side? And this is our second topic, is our chalk, right? Or MSS, as I prefer. It's more simple, okay? Chalk, it means change in state of delivery. And MSS means market structure shift. Okay, I'm not gonna write it because it took so long time. But this is change in state, is change of character, sorry. Change of character. So shock, change of character, right? Shock. And MSS, it means market, structure, shift. And it's the same thing. Okay, so for I illustrate this for you guys, how this plays out, like you already know the continuation, that's the BOSS. So now we can go to the reversal, right? And the reversal, you get your structure right here, right? And once you break here, then you have your chalk or MSS, whatever you want to call it. And this here is the line you are looking for. Okay, and why is that? because you have here your higher lows and higher highs. Okay, so in this point right here, okay, what is your last low? It's this little guy right here. Okay, so once you break this guy, you now change your flow, change your state of delivery of the price, you change your flux of the price to a downtrend. Okay, we're gonna use this a lot for confirmation entries. Okay, once we break this low right here, this protected low right here, okay, we reverse our currently trend. Now we have a bullish trend right here. Then we break this low, this last low right here. We're going to see we have some more rules to validate this roll, this low right here, right? But for now, once we break this low, now you have your market flow orders going down. Okay, so this is your chalk. Okay, this little guy here means your chalk. Right, pretty simple. Can be tricky, yeah, but it's simple, right? If we need to see something in real of this, okay, here we have example, right? We have a higher high, okay, high, low, high, low, high, low, okay? So market's doing this, high, low, high, low. Once we break here, we have our chalk or MSS, whatever you want to call it, okay? And so from now on, we have the boss right here for continuation. Okay, it's that simple, not hard at all. And I spend you a lot of hours watching ICT content, right? So anyway, I deserve a like. Just leave it a like. Okay, changing state of delivery, right? It's almost the same thing as the MSS, okay, but it's a little more detailed and microscopic way to see the MSS, right? And why is that? Because the changing state of delivery it's a sequence of up close or down close candles. Then once you lose it, okay, your state of delivery or your flow it will change. It's a way to anticipate a little bit the market structure shift. Okay, like in this case right here, we have the sequence of down close candle. This is the 4 hour. Okay, let me put this in 15 minutes. Maybe it's better to see because we're going to have a more candles to see it, right? Let me see where. Okay, right here. I already found one that you guys can see, right? Right here. You have right here a sweet sequence of up close candles, okay, or a down close candle. That's easy to see. I'm gonna grab this example right here, okay? It happens all the time, but I will grab this example, right? We have the sequence of down closing candles. We have one down closing candles, we have 2, 3, so we have a sequence of down closing candles, right? The candle who antecedes this sequence right here, in such case, this candle, this positive candle that previews the sequence of down close candles, it's going to be your SIST, your change state of delivery. And that's an important part because it's the body of the candle, not the wick of the candle. It's going to be the body of the candle. Okay, so if you like in the MSS and you need to wait for this happens, okay, and the structure in the structure shift, you need to wait for this week has been taken, right? Because it's your last low, is your last high, this guy here. In the SIST, you can wait for this previous candle, the end says the sequence of down close candles to be taken. So you're gonna draw a line in the body of this candle and wait for it to be taken. So you can anticipate a little bit, okay, the the market structure shift, right? Instead having a trade like this, you can tie it up a little bit your stop, right? And have a better risk to reward in these cases. Okay, so this is very usable. SIST is quite advanced model. It's not even a model, but it's such an it's advanced concept. All right, SIST is not as beginner friendly as the market structure shift, but it's the sequence of down close candles, and the previous candle, the high candle, is your SIST, and it's the same way for up close candles. Okay, it's just reverse, right? So now we talk about the SIST, which is a very important thing, right? So where is my drawings? Right here. Okay. So now we need to talk about breaker blocks. Okay, and the breaker block, let's draw the structure again. Okay, this is important. We have the structure and we have our MSS right here, or chalk, whatever you want to call it, right? We break it and we come back, test this zone right here, and then continue to pushing down or to pushing up. Okay, the breaker block is the block of orders, right? In this particular region, this region that makes the chalk, the MSS, whatever you want to call it, you're gonna see, I'm gonna show you, right, is this region that price most likely come back, retrace it, and test it. Okay, so you have this level right here, this important level. This is the breaker block, is the block where the price break and come back to test it. Break, in this case, this MSS right here. Okay, so let's find example of this in the charts so I can teach you guys this properly. Okay, right now we have right here. Okay, we have, I want to show you guys this. Okay, we have way up, boss, and now we have our chalk right here. Okay, and we have a retest, right? We have the retest right here, but not going into the details. But anyway, the chalk or the MSS is right here. A structure shift is right here. Okay, so what you can observe here, what is the block that make this price break? And I mean the block, I mean the candle. Okay, so in this case, the breaker block, it's going to be this little guy here. Okay, so you can add a rectangle in this entire candle right here. This block of candle makes the low, right? And once the price break it, it immediately come back to test it. Okay, so this is a breaker block. Some guys can refine this breaker block for this breaker block. It's also fine. Okay, as long as you understand there is a block of orders right here, and once the price break this block of orders, okay, that's going to be your retracement zone for the price. Okay, so you see the price test this zone right here twice, once here, then come back, test it again, bounce it down, and then continue the trend, right? So the breaker block, it's an important region, right? So the next, I can stay around here because we're gonna talk about fair value gaps and inverse fair value gaps. Okay, so fair value gap is this gap that happens between one candle. We have three candles in this case. Okay, we have one candle, two candles, and three candles. So the fair value gap is the gap that happens between candle number 1 to candle number 3. Okay, you see in this particular case we have a gap from here to here. Okay, this gap here, this is important. Okay, this is a fair value gap, right? And what does that means? It means in this region we have liquidity. right? Because the whole ICT traders are going to shorting in this shit, okay? Such as the inverse fair value gap. But anyway, it means we have liquidity in here. So the market makers know for sure there are going to be a lot of players selling on this fair value gaps. So what does that mean? It means liquidity. For what? For execute orders, right? So they know the most traders are going to sell here, right? As the ICT teaches, gonna sell here with the stop here. And what most happen in a fair value gap, and you're gonna see it, if the price touch the fair value gap, right? Grab the liquidity of the fair value gap and then distributes. It's very common. So fair value gaps mean liquidity. Okay? Yes, we can do entries on fair value gaps, but we need to have confirmations to do so. Okay? So said that, is this important concept, the fair value gap. Is the gap between the candles. Okay, candle number 1 to candle number 3. This candle number 2 provides us a gap right here. And this is our fair value gap, okay? Which means liquidity for us. Okay, good entry spot. And in other hand, we have the inverse fair value gap that is literally the inverse, right? So here we have the fair value gap. In the inverse, you're going to wait for this fair value gap has been taken, right? So here we have a perfect example of inverse fair value gap. Okay, we have a fair value gap right here. That price break this fair value gap and reverse it, right? Which means more liquidity for runs. Okay, because once I told you we have a lot of ICT traders buying here, going long here, right? And put their stop loss right here. So ICT traders got long from here, right? Price push up a little bit, tricky than all, and then push lower and lower, and then trigger all those stop losses right here. And what happens to the price? Boom. Right? So inverse fair value gaps are perfect entry zones for us. Okay, because it will accelerate our price movement. Okay, so inverse fair value gaps, you're going to see me using a lot for entries because it's the most efficient way without a confirmation, without a structure shift. Okay, is the most efficient way to use inverse fair value gaps for entries. Okay, so this is the inverse fair value gap. Very important for you guys to know this. Okay, so BPR, I'm gonna to maybe dig a little bit to find a BPR because it's not too frequently to happen. But a BPR, what is a BPR? Right? It's a balanced price range. And what does it mean? You have a balanced price range. It means that you have an inverse fair value gap with a fair value gap. Okay. Let me see. I saw a BPR today in somewhere. I don't remember where. Right here. Right. It's a little tricky to find BPRs, but we have BPRs. Right. Here we have inverse fair value gaps, and here we have fair value gaps. Right? So what does that mean? Like you have the fair value gap right here, okay? And you have an inverse fair value gap from this candle to this candle, right? Because this only provides us a gap right here. So we have this inverse fair value gap right here, right? And what you have here in this conjunction right here is the BPR, is a balanced price range. Once you have the inverse fair value gap with the fair value gap. And this is a very, very, very powerful entry, okay? As you can see right here, look how the price reacts in this area. And this is a 4-hour time frame, sorry. 4-hour time frame. Look how the price reacts on this type of area, okay? So balanced price ranges are magnets and are very strong for retesting areas. Okay, balance, sorry, price, touch here, touch again, touch, 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 didn't break through, and then distribute lower. Okay, so BPR are very important regions for us, right? So other concept that's very important and misunderstood by many of people is order blocks, right? I'm not going deeply what is an order block, right? But an order block, I can say, and I can see here where is our block, is this little guy here, right? And you must confusing like, oh, I learned order block in the other way. That's the like the opposite candle before the impulsive lag, whatever. So that's wrong. Okay, the order block means the block of orders who creates the manipulation, right? So you're going to seek the candle who creates the manipulation, and probably it's going to be a heavy candle or a candle like this with a heavy wick candle. This thick candle right here. Okay, this is going to be your order block. This block of orders right here. Okay, as you can see, it works perfectly fine, right? Because this is the correct order block. After you purge the liquidity right here, and this is our next topic, okay? After this liquidity purge, this manipulation, institutions leave us a footprint. And this footprint is where they put on their position, right? So they make their position on this region right here. So they spend a block of orders right here, spend a lot of orders creating this block of orders. So why? This is why it called order block, okay? Because it's a block of institutional orders who manipulate the price, okay? This is a very important concept for you guys. Said that, okay, we have the order block and we have the turtle soup. That is this little guy that I marked here, okay? And the turtle soup is liquidity, okay? And turtle soup is the base of our trading model. The base of CRT is turtle soup, right? And the base of market is turtle soup, because turtle soup is about to grab liquidity, grab retail liquidity and distribute the price against it, right? So once you understand turtle soup, you will win the market for sure, okay? So turtle soup, ICT talks a little about it, barely, don't touch about this subject of turtle soup, of grabbing liquidity, of fake breakouts, whatever you want to call it, okay? Honestly, I don't know, because it's the most powerful tool, powerful way to trade is turtle soup, right? You wait for a liquidity grab in a key level, right? That we're gonna talk about key levels in a specific lesson, right? But for now, you must know this is a high, and we have liquidity on this high, right? Retail trader trying to short here, and retail trader trying to long here, right? Both are wrong. If you're trying to long here, you are a dumbass. If you're trying to sell here in this high, just this is a resistance, I'm gonna sell here, you are dumb as well, okay? Because you're going to be wrecked, as it happens right here, because all the smart money players are know about that. There's gonna be people longing here and gonna be people shorting here, and what they're gonna do is they're going to manipulate this liquidity and then push the price whatever they want, right? So this is the turtle soup, right? And the last concept we will talk about is the draw of liquidity, okay? Draw of liquidity, aka DAO, okay? Draw of liquidity is the target, okay, for this kind of operation right here, So you have your turtle soup, okay? You have your order block right here. And I'm going to just mark the order block as I usually do right here. So you know this is the bottom of the order block. You get your retest right here, and you get your target, that is this liquidity here. So the draw of liquidity is the next target liquidity. So where these players are going to dump this contract, they are accumulating here in the next liquidity spot that is here. Okay, so every exit is an entry and every entry is an exit. That makes sense for you? Because they need liquidity, okay, and I mark it here as the okay, draw of liquidity. They need this liquidity to make their profits, right? Like here you have a doll, right? Because what? You have turtle soup this low right here, okay? Turtle soup, grab the liquidity. You have what? You have your order block right here, okay? I'm gonna leave this here. You have your order block, the candle who creates the manipulation, okay? You have retest of the order block, and then you distribute the price until where? Until where you have liquidity, and this is this point right here. So this is your doll. The doll, it's going to be your target. Okay, it's the next visual liquidity that players going to dump their contracts. Okay, so this is the basics for ICT concepts. Okay, I guess is all you guys need to know. Of course, we dive into very quickly, right? But I guess it's very complete about all these types of entries and stuff. So this is all the concepts, the ICT essentials that you must know to keep going to this course. Okay, we're going to talk about liquidity, right? What is liquidity in the market and why the price goes whenever they goes, right? It's because of liquidity. Okay, so in today's class, we're going to talk about liquidity. That is the most essential part of this type of trading. Okay, we need to know what is liquidity in depth. In this video, I'm going to show you what is liquidity. Okay, so before anything, don't forget to hit the like button. I notice you guys are not hitting this like button. It's very important, okay? And comment down below like, hey Sky, I'm here, okay? That I want to know if you are there, right? So that being said, let's jump into straight for our class, okay? So no, I got no, right? No, right. What is liquidity? So you guys have wondered what is liquidity? Oh, okay, liquidity is like contracts and stuff, okay, but you know how deeply liquidity works? Like providers of liquidity, players, retail traders, institutional traders. Why liquidity is the most important piece of the puzzle? You know about that? If you don't know about that, you're going to learn right now. So, first thing, what is liquidity? Right? And per se, you can say liquidity is contracts, right? That's not wrong. But liquidity is basically the counterpart of each contract, which means I separate this image right here, can illustrate better what is liquidity, right? So in this case, right here, we have some asset right here, and I want to take this book of orders so you guys uh, can properly understand, because I know that a lot of you guys never saw this particularly, but this is how a lot of traders negotiated daily, right? Only with the volume, because it's very useful. Okay, But the fact here, I know a lot of guys never saw this in your life, only see charts and candles and stuff, and you don't know how liquidity works, right? So right now, I'm gonna teach you how liquidity works. So first thing, we have some asset right here, and we have the price, okay, of this asset. So you can see the asset moves from half to half point, okay? That's not that big deal, but you see that in every level of price right here, every tick of that price, we have sell orders and we have buy orders right here, right? And what makes the price moves is the aggression, right? You see the asset is in this currently price right here, okay? And you having 20 people wanted to buy and 500 wanted to sell, right? So for the price comes up to this level of price right here, this 80 right here, okay? The buyers need to consume every every contract in here. The buyers need to consume 501 contracts in the sell side, right? So this is how the price moves, right? So the buyers need to consume every contract in here in order to make the price moves up, right? And if for some reason, like, okay, I want to buy 2,000 contracts, okay, you will consume this level, this level, this level, and a part of this level. So if you just having 2,000 contracts, I don't know why, but you have 2,000 contracts and you hit the buy button, right? The price will consume this, consume this, consume this, and stop right here. So this is currently your price, and this is how market moves, right? And the same thing for the sell side. Okay, if sellers want to make the price lowers, you need to consume this, like 2,000 contracts. So you got to consume all this and this and this and this. Okay, yeah, I think this. Like the price is probably going to be right here. You see? So for in order to price move from one side to another side, we need to consume lots, right? And what happens if the price is moving up? Like not one guy just come here and just click the buy button and consume 2,000 lots. What if just the price just come up a little bit slowly, like mitigation movement, something like that, like the robots, the algorithm is moving the price, because you have to understand that once you have like a structure like this, okay, this is the point that market makers actually inject their lots in the market. And this middle part here is most likely or stops of the retail or just high frequency trader, like that little robots, the liquidity providing robots that makes this movement right here. Okay, but anyway, so you need to keep in mind that the big players lots are in the extremities, like in highs and lows of the market. Okay, right. So said that, if the price just is moving slowly and graduating, and some guy who has like 20k lots just come in here and like once the price consume 500 here, they put more 500 and put more 500 and put more 500, and don't let the price break through this. You know what this is? This is called iceberg. Okay, iceberg order, because you can see this order in the book. Okay, and yes, you have softwares can do this shit, right? But the fact is, this is called iceberg orders, right? And this is how the manipulation movement occurs, right? This is how you stop a manipulation move, it's with iceberg orders, right? And I'm gonna explain you in 1 minute. Okay, so let's see in, sorry, right here. Okay, let's see right here, right in this price right here, and I'm gonna paint it yellow, right? This price is an old high. Okay, so you have a high right here. Okay, so you have two types of player in the market, like dumb retail, like really dumb retail, and you have like a smart retail. Okay, and the real dumb retail, it's going to see this level right here. Okay, and once price pushing up, okay, this really dumb retail, it's gonna click buy right here. So the really dumb retail gonna go long here. Okay, and where is this order of this dumb retail? It's right here. Okay, because it's a stop order, and stop order, it's a limit order like this one, right? But if the price are like here in this level of price, all of orders here appears to everyone, so it's limited orders, and all the orders from here to above doesn't appears, so it's called stop orders. Okay, it's like a limited order when you put you on your platform. Okay, it's not going to the books straight, but it's on your platform. Once price hit this level right here, the platform will trigger this order instantly for you. Okay, so this is a stop order, right? So the real dumb retail put their stop order, buy stop order right here. So once the price breaks through, he gets long. And oh my god, this price is going to the heaven, right? And yeah, but you have so one stop order here, and probably the stop of this dumb retail trader is right here. Okay, so keep that in mind. Now we go on to the second scenario. You have like the smartest retail trader. The smartest retail trader going to see this level as a resistance level, right? All of you guys are heard about resistance and support and all those shits, right? So the retail smart trade, he knows that he needs to sell right here. Okay, he knows he needs to short right here, but he shorts like he put the her limit order right here with this bunch of orders right here. Okay, and what happens is once you have sell order, you need to have a buy stop for take profit or for stop loss, right? And in this case, let's say the stop of this guy is right here on this level, right? So let's recap. You have a stop order right here for this guy who wants to short here. You have a stop order right here from the first guy who wants to go long here, right? And plus, you have the stop order from this guy right here who want to go long here. So what happens here? The institutional, the market makers knows about that, okay? Because it's classic, okay? So what they do? Just throw a little rock right here and let the magic begins. So they push a little bit of contracts right here, okay? And let the magic begins, because once we hit those limited orders right here, the price will consume all those lots right here. You see? Because you have not one, but you have a lot of them retail traders, right? So the price will consume those orders. And suddenly the price will hit here, okay? And the market makers push a little bit further from here, right? So the price activate now this stop orders right here. And activating this stop orders from the smart retail trader that's short right here, the price consumes a little bit of lots. Okay. And how they do to make this price stop? Iceberg orders. They inject orders at the level they want. Okay. So let's say we have 15K. This is like 20, like 15K orders right here. Stop. Okay. And you have like this in the book. So if you just trigger this 15K orders, the price goes to the moon. And the market makers cannot enter the price in the price they want, right? So how they do to use this 15K, sorry, for enter? They use all this liquidity has been provided by dumb traders right here, okay, to set up his position with iceberg lots, you know. So let's say we trigger a 15K lots, we need to fill those 15K lots with sell orders, right? Because if we not do this, price goes to the moon and the market maker cannot make his position, right? So this, guys, my little padawans, this is the formation of the order block because you have a block of orders right here. Okay, and let me draw you a thing for you guys. Oh my god, I just erased the image. Let me draw you a thing for you guys. What happens if the price comes to a level, suddenly have a lot of orders, right? And this price returns to another level and make like this. What do you see here? You see a candle with a wick, right? So this is the reason the best order blocks have a wick. The best order blocks doesn't have a body. Like you can have a body, obviously, but probably a time coincidence. But if you see this large wick on the candle who form the order block, the candle who manipulate the price, that's exactly what happens. Market makers are filling those books with orders to stop the price from this dumb money right here, trying to push price higher with their stops, her dumb stops. Okay, so this is basically how liquidity moves. Okay, and after the market maker make his move right here, he's now positioned. He's now like shorting 15K contracts right here in this price, right? And where in the seventh house I going to dump this 15K contract that I have because I'm shorted in 15K. Okay, so what can I do? I'm gonna short a little bit more here. Okay, I will short. So I short here, short here, short here, short here. And remember that like smarter retail trader, he their stop are here. The smarter no dumb retail because they're long here and their stop are here. Remember? So now they're going to use this stop to accelerate the price. And this phase is called distribution. They're using the real dumb money to accelerate this price right here with those a lot of stops right here. Okay? And this make the distribution movement. But anyway, they still have a problem. We have 15K. to dump in somewhere because okay, you short, you open your position, okay, you short your 15K at the price you want, right? But I need to move this price to somewhere. Where the fuck I gonna move it? So you trigger the distribution movement, and then you're gonna dump in the next high or the next low. In this case, let's assume that here it's a low, okay? And a low, and in a low, what do you have, guys? You have the same situation that you have in a high. You have the dumb retail, you have the smart retail, you have all those liquidities waiting for this guy dump his contracts in an old low or an old high. So this is what I talk about liquidity, okay? Because liquidity is the base of everything, okay? And I give you a free lesson of manipulation, institutional manipulation right here. But this is how the market moves, right? So they dump his 15K at the next low, in the case the previous low, right? So let's make this a real example right here that I want to give you, right? Okay, so here we can use this, okay? You see that you have a double top, like retail loves it. It's a real strong pattern and all those shits, you know? So you have what here? Liquidity, dumb money trying to go long from here, and dumb money trying to short from here because it's a resistance, okay? And the other is a breakout. Fact is, you have a lot of stop orders right here. You have a lot of stop orders right here, okay? Why this shit's like this today? I don't know. Anyway, and okay, let's assume that that guy made his move and now manipulates the price right here, took all that liquidity, and now he's positioned, right? Remember the distribution? It's a fast movement, fast movement. They all stop out, everyone who tried to long here. So the price, it's going to stop out everyone here, all right? And the next liquidity, and you can see right here, is this one, right? And I'm gonna mark this one because you have the same fucking situation right here happening, okay? But in this case, we didn't manipulate to go higher. We just used the stops from this region to accelerate the movement from the downside. You see, we get this liquidity, we realized the profit right here. They made the profit, right? This guy right here dump off all the contracts right here. So we have this reaction of the price right here. Okay, so this bounce of the price. And then they push price lower because they know that gonna have a lot of stops right here. And the price, boom, accelerates again because a lot of stops orders, right? So for this lesson, guys, is basically this. Okay, this is the most essential part of liquidity that you need to see in your life. Okay, and this is how the market makers move this market. Okay, and remember that I said the market makers are in the extremes. So here you have the market maker actuation. Here you have it, a market maker actuation. But here, like here in this, is just the high frequency trading. Okay, it's just robots, it's just algorithm right here. Right, in this leg right here, this leg right here is just robots, and this is the reason that we don't want to get anything done in the middle. We need to wait for a key level, remember, I always say about key levels. Key levels is the old highs, old lows that are liquidities. Key levels are liquidities from the market, guys. Okay, we're gonna dive into the key level lesson, of course, but we need to actuate just in the key levels, just in key levels, because theirs is where liquidity is, and the market makers are putting their money on it. Okay, so sleep with that. I'm gonna talk about internal and external liquidity. Okay, so internal liquidity. What the fuck, man? Internal liquidity and external liquidity. Okay, so before we start, okay, make sure you have seen the lesson number 5 and all those lessons before. That's very important. And don't forget to hit that like button, because I'm seeing you guys are not hitting that like button, and this is the only payment that you need to give me, okay, for make this content get to most people possible. Okay, so hit the like button, leave your comment. Okay, you can leave any comment that you like. I will answer all of your comments, okay, because I read all of your comments. And before we dive into the class, okay, don't forget to join the Discord, because the Discord is very important. We have the community on Discord. So link is down below. Join our Discord. Okay, said that, let's dive into the content. Okay, so the first thing we need to understand is the structures that we talk about in the last classes. Okay, so that boss and stuff shit. Okay, so in each and every structure, you have what? You have highs and you have lows. Okay, and this highs and this lows generates what for us? If you see the last lesson, you're going to know this answer. The answer is liquidity. Okay, this highs and this lows generates liquidity from us, for us. Sorry. Okay, so what is external liquidity and internal liquidity? Okay, the first thing you need to understand is this structure. Okay, we need to have, and I'm not going to deep on structure lesson right now, but this structure, okay, it needs to have something like this to validate our structure. Okay, and see, like, what do you have to have? You have to have this turtle soup right here to validate a structure. Okay, you once validate the structure, you only validate the structure once you have this turtle soup, once you have a liquidity purge of internal liquidity, and you're going to learn what is internal and external. Okay, but once to do that, I need to show you this. Okay, so let's continue like the drawings right here, like this. Okay, so once again, turtle soup. So what's the point here? You have this point as an external liquidity. Okay, this point who purged the internal liquidity, and now break this high, it becomes an external liquidity. Okay, and this high is external liquidity as well, because like you not internal, nothing right here. Okay, so you are external right here and right here. This parts right here is easier to understand, because let's say that's the outside part of the price, of the graphic, of the range. The outside part is easier. So here you have your external liquidity, okay, but the internal part of the price is a lot trickier, because you have to have this turtle soup right here to consider this external. Because if you don't have the turtle soup, this liquidity right here, it's going to be what? It's going to be an internal liquidity. Okay, because it's in the internal part of this leg. Okay, and this liquidity is going to serve us as liquidity for future Taro soup to move the price higher in this case, since we are in the bullish example right here. Okay, so here you have the first internal liquidity. You have a second internal liquidity, which is, and I'm gonna show you in a few seconds. Okay, let me draw my path right here. You have this internal liquidity right here, and you asking yourself, where is the internal liquidity? The internal liquidity we have here is this little guy, fair value gaps. Okay, and why fair value gaps? It's liquidity from us, and especially why fair value gaps is internal liquidity. Well, first thing, fair value gaps are internal liquidity because they are in the internal part of the movement. Okay, that's very easy. But the second part, the inverse fair value gaps, are liquidity because it's the same thing that happens in the manipulation. Okay, a lot of people want to go long from here, put your limit order right here, right, and put their stop loss right here, or something like that, because you don't have to predict what retail are doing. They are unpredictable. They are dumb and they are unpredictable. So you don't have to know what the fuck retail is doing, right? But we can assume, not for sure, obviously. They put their entry order right here and their stop right here. So you get a stop hunt right here, okay? So the fair value gaps work for us as internal liquidity, as this internal lows that we have here, right? And the external, okay, liquidities is this little guy here. Now let me just draw. It's easier. This guy is external, right? This is external. This is external, right? This, if this happens, just purge the fair value gap. It's not external liquidity. For this low turn into external liquidity, it needs to purge the internal low. Okay, like this. It needs to Taro soup something. Right here, they are not Taro soup anything. Right? He is just taking the fair value gap liquidity. That's fine. But for make this low right here external low, we need Taro soup again. Okay, and now we have external liquidity at those points right here. Okay, so this is the external liquidities. Okay, and I will mark with the circle the internal liquidities. Internal liquidities, internal liquidities, internal liquidities, all here. Okay, and if you have something like this right here, this is the internal liquidity as well. Didn't purge anything to make this external liquidity. Okay, so I guess it's this, guys. This is my whole point of view for external liquidity and internal liquidity. And for this lesson, it's all you need to know for that. Okay, this is going to make more sense when you put all the pieces together. Okay, and if you're liking this content so far, okay, this bunch of videos, this series of videos, this full smart money course. It's not even a CRT course because we talk um a lot about other stuffs as well that I need to teach you to you learn correctly and properly the CRT. You need to pass all those smart money content before you dive into the CRT content, right? And if you're liking this, just leave a comment, okay? For I know you to liking this type of content, right? So I want to go to your charts right now, right? And spot all those external, internal liquidities. Like right here, what do you have here? You see something? Because like I can see clearly a lot of things right here, right? Like this, you have here, this is external right now because broke it right here and purged this liquidity, right? This is internal liquidity. Didn't purge right here, right? This here, external liquidity. Purge right here, broke right here. Okay, this is internal liquidity, right? This is going to be external because purge all those lows right here. And those lows are external as well because purge here. So once you have a purge and you have a break of structure, this became your external. If you don't have a purge like this is going to be internal. This is going to be internal. Okay? This is going to be internal. Right? This is going to be internal. And all the meaning of the internal liquidities is to provide liquidities for beginning an external movement like this, right? So I hope this video made this whole point clear about structures and internal and external liquidities, right? So I'm going to recap that we have internal liquidities. We have our first internal liquidity, which is highs and lows. Internals, obviously, right? And the second, and I'm going to put right here, it's fair value gaps as the internal liquidity. And the external liquidity, it's what? Highs and lows who purge the liquidity. Total soup, internal liquidity, right? So sleep on that content, digest all of it, okay, and be prepared for the next lesson. What we're gonna talk about today is market behaviors and in important regions, right? In this lesson, we will not talk about how to spot and mark that important regions, but how the market is going to react at that region, right? In the few uh, past lessons, we will discuss about those regions, but for now, we want to talk about failed auctions and market manipulations. Okay, this is the topic for this lesson. So failed auctions and market manipulations and how the price will behave in that kind of situation, right? So let's say you have a range, right? You have a range right here. right? Price is fairly being traded in this range, right? We have two types of scenarios for market get out of this range. Okay, actually, we have three types of scenarios. I'm forgetting about one. But the first type of scenario is we break out here and price just accept negotiating lower here. And then we have a solid breakout, right? Of a lot of times we retest this region and then push down, right? So this is one scenario that we have for price move, right? The other type of scenario that I want to talk about is, let's assume we still on this consolidation here. So we're going to still be in here, right? What you can expect if we going to stay in here, because you're seeing like if we have a range, and we're going to talk about more of ranges later, like session range, fair value range and stuff. But if you are having a range, it means that players are agreeing to negotiating here. So this is a fair price, right? So let's assume, okay, and let's expect the price will continue on this range, right? So we have two options, right? We have the first option, that is a failed auction, right? What is a failed auction? Failed auction is basically play, players try to push price down, not able to continue that breakout that we see before, right? And then push to devalue again, right? So this is one scenario, right? The failed auction, okay? So the second scenario, it's going to be a stop hunt. Yeah, it can happen, right? It's very plausible to happen. And a stop hunt is a way the players grabbing liquidity for moving the price, right? So stop hunt is going to be more aggressive move than push up, right? You can do like here and this. What the fuck? Here? Yeah, like this. So it's going to be more aggressive. Okay, stop hunts. And we're going to deepen it more further in this lesson, right? But for now, right? But for now, okay, we need to understand that we have two types of scenarios that we going to range in here again, right? So scenario one is failed auctions. Players trying to push price lower or higher from this range, not able, and price come back to the value right here. And you have a stop hunt. Okay, this is the two scenarios that price will continue to move in this range, and we will assume that price will continue to move in this range because it's already showing us that price is in this range, right? So we not try to predict anything, right? So this is the base for the model itself. Okay, it's very important that you can understand this, and once you understand this, uh, you're going to benefit it, right? Uh, okay, so for the stop hunt, what happens is, and we're going to see this more further in the lessons, right? We usually see in these ranges right here, that market ranges, right? We have low liquidity, like sessions and stuff, like it's low liquidity sessions. So it's lack of liquidity, right? The lack of liquidity happens. So players cannot move the price because it's not like the counterpart, okay, to have the deal. So some players, and I mean big players, okay, and there's a difference, by the way, for big players and market makers, right? Market makers are liquidity providers, and big players are institutions, right? So what we want to see as a stop hunt, okay, is institutions push the price until some point that have a lot of stop orders, right? This is a fact. To get enough fuel that market makers cannot give to them, right? To what? To build their positions, right? Because what happens when you get a stop order? right? Like the order, let's say the price is here, okay? You have a stop order right here, right? Let's put in red right here. Like you want to short. If the price comes down here, like this, oh, sorry. Um, brush. Okay. If the price comes down here, you want to short. Like you want to be trigger and you want to short. So this is a stop order, right? This order here, it's not a limit order. It's not like in the data center, right? This stop order is only on your platform. And once hit the criteria to activate this order, your platform is going to send a market order, right? So this is a not limit order. But it's for sure players and more advanced players can spot those liquidity points and say, okay, here probably is going to be a lot of liquidity resting. So we can push the price down here to activate all these orders, right? So we get the sell counterpart right here to build our long position, because every position you're going to make, you need the counterpart. Okay, if you want a long here, you need to be sellers. You need to be passive sellers to build your long position, because you're buying. You need someone selling to you, right? Because if there's no one to sell right here, you're gonna take worse and worse and worse and worse and worse price until you fill your order. So for the big players can build their position, they do this stop hunt thing, right? Because they know that here, right here, have a plenty of stop orders, a plenty of counterpart to build their position, and they are going to start longing and longing right here, right? And by the way, this is how the order blocks are formed, right? But we're not going to do in this class, right? But what I want you guys to understand is this is a type of movement, right? This is a stop hunt movement, and it happens frequently in the market, right? Uh, it's not every day that's happened, but yes, it's happened like, let's say 3 times a week in some key sessions, right? You're going to see this stop hunt movement, right? So it's very common. It happens with certain frequency because players need liquidity to build their position, right? And the second type of movement that we want to talk about is the fail auction, right? Because there's a really different, completely different type of movement than a stop hunt. Okay, uh, even you say in the graphics you have the same kind of movement, like you purge these lows right here, and then reclaim it, but it's a way different a failed auction from a stop hunt. Okay, so a failed auction, we're going to see players with intention pushing down right here. So they're pushing contracts down and getting absorbed right here for another player, right? So you probably going to see in the book, okay? And I'm not telling you that you need to use the book for trade this specific model, but it's important for you to know that what you're going to see in the book, it's in these levels of price right here, you're going to see a lot of transactions, a lot of transactions, a lot of contracts being absorbed from the buy side, right? And in the stop hunt, in the otherwise, you're going to see no counterpart right here, right? So let's say in the stop hunt, you're going to see, let's say, oh, this is too bad for right. You're going to see like 500, no, like 200. Let me put a little, like 200 contracts, and then you can see like 200 contracts, and you can see 200 contracts. Okay, it's just example, right? And the counterpart, like the buying part right here, because remember this is stop hunt, you are activating stop orders, right? You're going to see the counterpart like this, right? Like you can say like 5 contracts here, like 2 contracts here, and let's say 3 contracts here. So you have no counterpart here, right? That's what you're going to see in the book for a stop hunt. And for a failed auction, it's like a completely different situation because you have the intention here of the players, like raising up, right? And you're going to see the exact same counterpart, okay, here. So you know the price is getting absorbed because you have a lot of transactions right here, right? So this is the main difference between the failed auction, that is this, from a stop hunt, that is this, that you have no counterpart, just sell orders, sell stop orders, right? And same for the buy side, same thing, right? So this is something that you guys need to understand and dominate completely, because this is going to be the base of the 5 a.m. model for this course, right? Not going too deep. How we're going to enter, how we're going to do to approach right now, but in the few lessons ahead, I will teach you properly how to do it. So that's very important that you guys understand this. We have these two type of movements. Okay, so we have the first one, the failed auction, that is players are getting absorbed, and then we come back to the range, right? So players are getting absorbed right here, and then we come back to the range, and we have the stop range that you have a strong movement and then a strong push down again, right? And then this is how you form the order block. So in this lesson, we're going to talk about a major and important thing. We're going to talk about key levels. So grab a coffee, sit on your chair, right? Relax, pay attention, because this is very important, right? So today we're going to talk about key levels. But first of all, I need to ask you a little favor. Just, I don't charge anything for this, so just leave your like, leave your comment, and share if you want it, because it helps a lot this content to get to other people's and help them also, right? And don't forget to join the Discord. I trade live every day there and have a lot of things going on. So links in description. So join the Discord, right? Right. So key levels, guys. We need to understand what is a key level, right? And why they are important, right? So first thing, what is a key level, right? Key level, it's, let's say, important. Oh my fucking god! Point of interest, right? You got it. So key level, it's an important point of interest, which means the key levels are potentially a reversal points, reversal, or can indicate a continuation. Continuation. Okay. So reversal or continuation, right? So this is key levels. So how do you, like, you spot key levels? What do you use them? Well, we cover all in this video, right? But for now, you need to know key levels are important point of interest and potential reversal or continuation points, right? I know the lettering is not pretty good, but anyway. So how can we identify the key levels? We had two types of key levels, right? So we have key levels as price key levels, right? And we have time key levels. Both are important. Both has their importance, right? So price key levels is basically um, like highs and lows, right? This is a key level, key level, key level, key level, key level. We're gonna talk like more deeply in this, but price key levels are like important regions. Like here, you have a key level. We reject from here, right? So here you got price key levels and time key levels. By the other hand, it's a time, like a window time. Let's say, uh, just grab random. You got this window time here, right? So it's most of the time the inside key levels are the inside key levels, sorry. The time key levels are inside the trading session, right? So this whole trading session here is a key level. I don't even know. Yeah, possibly this is a trading session, right? So we have three types of trading sessions, if you don't know. We have the Asian, right? Asian trading session. We have the London trading session. And we have the New York trading session, right? AKA cash session. Cash session, right? Because the most money traded in the markets happens in the New York session, right? Like if we need to classify this, like this is like 1 star, like I made a star here. This is like 2 or 3 stars. Let's put a 3 stars here. And New York is like 6 fucking stars, you know? Like, so Asia, we just don't move much money. London, we move a little bit more money because, London's kind of okay. But New York is the most amount of money in the market. Okay, you got a brief question about sessions, right? So you know what is a Asian session, London session, New York session, and how much money we move into those sessions. So we have those time key levels, aka sessions key levels, and we have price key levels that are some important levels in the chart, like this one, right? And as you can see, those important levels, such as price or time levels, we can reverse or we can continue, right? So, said that, uh, let's start with the price key levels, right? And the price key levels we have, um, let me put it on the 1 hour here. It's easily to see, right? This is like dollar yen, but it works and it's applicable to every asset that you're looking for, right? So key levels, okay, you have two types of the price key levels. You have the external key levels, let's call it that way, right? The external key levels, and you have the internal key levels, right? Both are really important. But if you want to classify like the most important one, this is basically the external key levels, right? Internal key levels you can like align with your lecture. Like if you're doing some kind of trading and you like have a line of thought and some trading idea, you can align the internal key levels with your trading idea, right? But the external key levels here is the most important one of this both, right? And we're going to go over that right now. So what is the external key levels, right? Let's draw. We have this kind of situation here, right? This is a random, right? Doesn't matter. But the external key levels is points when market like rejects and retrace, creates a new high or a new low. So we have a key level here, 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 right? So every time that we get to this key level here, we have the possibility to or reverse from here or continue from here, because this is a really important level. And the reason why is because price comes here before and reject this level once. Like here, if this is a chart, like price comes here and reject going higher from here. So which means that we have a lot of sellers pushing price down from here, right? So this is important level that price comes here, test again. So, oh, okay, we can reverse from here. Or if we gain this level, most likely we're going to expand, right? So this is the importance of the external key levels, because it's points of the price that we reject a lot and creates new high or new lows, or we're going to expand in the test phase. Like the test phase is the retest phase, as you can call it, right? So this is the importance of the key levels, and the external key levels are basically, if you want to like essentially resume what is the external key levels, are highs and lows, right? But not any highs and lows, like structural highs and lows. Like if you have like let's say uh this kind of thing here, the key levels here is going to be the structural highs and lows. So here, 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 right? Here, 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 right? Possibly here you can consider as well. So this key levels here we're going to talk about. This is the internal key levels, and we get some more internal key levels, right? But this is the internals. You want to consider the externals for the most important key levels, right? For like decision making key levels. Right, so we talk about the external key levels here. Let's mark some external key levels in the chart, right? So let's take a random day here. Okay, so what we have here, right? So this key level, key level, key level, key level. This is not a key level. Why this is not a key level? Because you see, there's no new structure going on here. We just like retrace, retrace, and boom. Like if we go into that deep here, this is gonna be a key level. But we do not create a new structure from here. So this is not a key level, right? This can be a key level, key level, key level, definitely key level. Here we got key levels as well, right? So all those points, there's no, yeah, this is a one important key level. So you guys getting the idea, right? Every high and low that creates a new structure is going to be a key level, right? So here you have a key level, right? And this one is it's kind of hard to see because you're like internal here. But what you did in fact here is come here, push down, push high, push down, create a new structure here, and then push up, right? So here you create a new key level, okay? And if you're gonna mark this key level here, okay, just gonna put a line here, you're going to see that we respect this area because it's a valid key level, right? Otherwise, this is not a valid key level right here because we did not broke any structure. So, okay, right? This is an important point to be aware of. So key level, key level, key level, key level, key level, key level, key level. You have a lot of key levels here. This is accumulation, right? Key levels, both. So you got the idea, right? Important key levels. That is mean that every key level you're gonna trade? No, because you need to align with certain things, right? And by the end of this course, you're going to learn to align the price key level with the time key level. That's majorly important, right? And you're going to have the confirmations and stuff. So, but I need you to understand first what is a price key level, highs and lows, right? Let's remove the drawings, right? And now the internal key levels, right? The internal key levels can be, can be, can be, can be this guys right here, right? This, when you have a leg like this, right? You putting those key levels like new key levels. Let's see here. This is actually a yeah, internal key level. This is an external key level right here. So I'm gonna put an E right here. But otherwise here, here, let's say here, and you see that respect here. Here is external one now. Here internal key level. Here internal key level. Here internal key level. So all those little lows in the way like this is going to be internal key levels to a possible retracement, right? Because if you're going to reversal, you can only trade the external key levels, but if you're going to trade continuation, you can use the internal key levels to align with your trading idea, right? So the internal key levels, you have this, let's say the internal lows and highs, right? In this case, you're gonna not use the highs because you're an expansion leg, like long leg, like a bullish leg, right? So you're gonna use the lows because you want to retrace cheaper and expand. So retrace here in the key level, expand. Retrace here in the key level, expand. Retrace, expand, retrace, expand. So, right, internal key levels. And I have the second type of internal key levels that is fair value gaps, right? This is a kind of quite a polemic topic, but yeah, fair value gaps you can consider as internal key levels as long as you are with the trend, like, and you just use for alignment. You're not going to use like a enter or not situation. Like if there's a fair value gap, you're gonna enter. No, you're gonna use to align the trade. Like okay, we are bullish, right? We are bullish from here. Uh, I have like an internal key level here. Like you can see, right? We are bullish from here, right? I have two internal key levels right here. I'm gonna mark that. Two internal key levels right here, right? I have a fair value gap right here. So you're aligning all those things, right? You have a key internal key level, you are bullish, we have the fair value gap, so you can align uh, the fair value gap in those kind of situations. You don't want to like blindly trade a fair value gap like this because you get wrecked, right? But if you use the fair value gap to align of what you're seeing, well, that's kind of good. That's kind of good. Like in the same situation here, right? You have the fair value gap, you have the internal key level right here, internal key level, because look, you're doing this, so internal key level, right? And retrace here, expand. So if you use the fair value gap with the internal highs and lows, uh, yeah, that's a good idea, right? So okay, we talk about the external key levels, internal key levels, the both types, right? Let's talk now about the time key levels, right? The time key levels is is the session key levels, right? So we have uh, here, you can see here where it is. Oh, here we have, I need to put on 5 minutes to get it better for you guys to see, right? So Asian session, it begins at usually 7 New York time, 7 p.m. New York time. So you can like trade here. I'm gonna put a vertical line here. I'm gonna put a vertical line here. You can consider this as the Asian opening, and you can see that here at the Asian opening you have like a larger candle, right? And the Asia we can consider we go until 3 p.m. till 3 p.m. right? So 3 a.m. sorry, 3 a.m. New York time. This is always New York time, okay? Just make sure you put on New York time here. And this is the times on the New York clock, right? And the London session, it begins the 3 a.m. and goes until the 9 a.m. So this is the London session, and from here now you have the New York session, right? So you got those main sessions, and the New York session is going to the, you can consider 4 p.m. right here, and the 4 until 6 we have some kind of void. Like you can like drag it to 6, but honestly I just prefer going to 4, and you have no business to do after 4 p.m. as well, right? So you can consider the sessions as Asia right here. So I'm gonna put Asia right here, the London, and New York right here, right? So basically, what we want to do here, unless you're like living in some kind of country that you can trade Asia to London, just forget about Asia. This low volume isn't even worth to trade it. But what we want to here, it's basically trade this twilight here, right? Between London and New York. Why? Because in London, sometimes we have expansions, sometimes we have consolidations, right? And if this is most case scenario, right? It's not a rule, but if we expand in London, possibly in New York, we're going to reverse, right? So I'm going to put New York as red. Possibly in New York, we're going to reverse, right? If we consolidate in London, this is pretty tough, right? If we consolidate in London, possibly in New York, we're going to manipulate and then expand, right? This is how we do it, right? Pretty simple, pretty straight. So what we want to get it in the London twilight to New York is get this specifically time here, right? That we shift the direction of the market, right? And I'm gonna teach you, of course, guys, how to do it in the next videos, right? But mainly, this is the time key level because it's the between of the sessions, is the change of the sessions. So you are in the New York, oh, sorry, you are in the London and go to the New York, and you have a lot of cash flow coming in to the market, right? So we going to try to catch these reversals right here, right? But this subject for another lessons, right? So for now, don't forget to like this video, enter the Discord, comment, and share this video because it's rocked. So see you guys on the next lesson. Okay, so that's all for today. Bye, guys. Now you know about the key levels, right? We're going to talk about the model itself, right? We're going to talk about this specific thing here that is the most powerful and easy Forex model you will probably know, right? So, uh, let's begin talking about our time window, right? We talk about the time sessions, right? In the previous video. If you don't watch it, go watch the previous video, right? So we talk about the key levels, the time key levels, aka sessions, right? So we know here that we have these, let's say this London here, right? And New York here. And in between we have this, let's say 9 a.m., right? This is a 0, okay, 9 a.m. And this twilight here is where end one session and begins the other session, right? So this is the between that we want to trade, right? And for the London session, okay, to simplify, and this is why it's called the 5 a.m. model for the London session, okay, if we took the 9, right, and withdraw 4, what we have 5, right? So basically, the 5 a.m. candle that you have here, right, is the whole London session, right? And this is why we use the 5 a.m. candle as our key level for this model, right? And I mean, 9 minus 4 is because of the 4-hour time frame, right? So what you want to do here is we're going to pack it up London, right, in one candle only. And this candle is going to be the 5 a.m. candle that starts at the 5 a.m., right? And it ends at 9 a.m. So we have this candle, and this is going to be like a candle, right? This is going to be the 5 a.m. candle right here. And this represents all the London session right here, right? This is why we use the 5 a.m. candle, right? So time windows to operate this, it's going to be as soon as close the 9 a.m. candle. So here you have 9, right? Until like the mid of New York session, right? Because you want to target the mid of New York session, because after lunch, like post PM, right? Session is more clunky and have not volume. So we will only trade the most volume time window, that is 9 until 11 a.m., right? That's important here, a.m. and New York time zone, right? And if you are confused about time zones, right, this is very important. You come down here on your trading view, this time zone here, you click here, left click here, and then you're gonna set the time zone here, UTC -4 New York time, okay? You're gonna put here, and then your chart's gonna be in this time zone right here, okay? This is very important. It it is pointless to trade this in your specific time zone, and I don't know where you're looking this, but you need to set your time zone to the New York time zone right here, okay? This is very, very, very important for you to do. Set the New York time zone here. Otherwise, this hours here is not gonna work in your time zone. Okay, this is New York time zone, right? So the window for this model, okay, we only going to look 9 a.m. until 11 a.m., right? New York time zone, right? This is your trading window, okay? You're going to turn on your PC at 9 a.m. and you're going to turn off your PC at 11 a.m., right? You're not going to trade it further than this, and you're not going to trade it sooner than this, right? Your time window is going to be 9 until 11, period. And why I'm saying this, because I see a lot of people trying to trade before and after, and will not work, okay? So stick to this time window, right? So, okay, once you have this time window, what you're going to do, like the first thing you want to do when you came to your computer, okay, you're gonna put a 4-hour chart right here, right? And you're gonna see in my screen, I have a lot of 5 a.m.s marked right here, okay? But what you're going to do is basically, right, you're going to spot the 5 a.m. candle right here. Pretty simple, right? Have like the 1 a.m. candle, the 5 a.m. candle, 9 a.m. candle, right? And this is the 30 a.m. candle. So you're going to spot the 5 a.m. candle, right? And you gotta draw a line here on the top, 5 a.m., right? High, and the 5 a.m. low. You're gonna just mark the highs and the lows of the 5 a.m. candle, such as this candle here, this candle here, right? This candle here, right? This candle here. You're just going to spot the 5 a.m. candle. Okay, this is the 5 a.m. candle. Okay, I'm gonna mark the low and I'm gonna mark the high, right? Simple as that. This is the first thing you're gonna do in your day, right? After that, the entry time frame is going to be the 1 minute, right? But the 1 minute is just a refinement, right? Uh, and why does this call it CRT? Because you will notice that if you drop down to 50-minute, that is the the time frame scale. For you guys don't know, I'm gonna draw here the time frame scale. So okay, we start from monthly time frame, then we're going to weekly, daily, 4 hour, 1 hour, right? The 50-minute, 5 minute, and the 1 minute, right? So this correlation here, okay, it it happens between one in, one off, one in, one off. So between two, right, you get the correlation. And what I mean by correlation is the higher one is going to be the analysis time frame, the lower one is going to be the enter time frame, Okay, the higher one the analysis, lower one the entry, right? So if you're looking to analyze the monthly time frame, you're going to have your entries in the daily time frame. Okay, you skip one here, and the entry is going to be in the next, right? So if you have the daily, if you're looking to the daily time frame to analyze your trades, your entry is going to be in the 1 hour time frame. If you're analyzing the 4 hour time frame, as we are, we entry is going to be in the 15-minute time frame. So okay, so why are you talking to me and telling me that we're going to enter in the 1 fucking minute, right? And I'll explain this later. It's a bit more advanced, right? But if you just doing the old school way, you just go to the 15-minute and wait for a CRT to happen, right? In the 15-minute, and that's your entry, right? But we want to have more confirmations. We want to improve our risk reward. We want to, you know, get a little anticipated sometimes. So what we're going to do, we're going to take this 15-minute, okay, and we drop down one more time frame, and then following the logic of time frames, we're going to have the 1 minute, right? This is like the Russian dolls, that like this, I don't know, draw the dolls are quite like strange. That dolls that you open a doll and you have like another doll inside. This is kind of weird, but oh, okay. And you have like a bunch of other dolls inside. Does not look at a doll, but you get it, right? So this is the same thing with time frames. They are fractal. So once you have one, you can have another small inside. Once you have one here, you can have another one small inside. Once you have one here, you can have another one small inside. So as long as you follow this rule here, right, you're going to be good, right? What you cannot do is like, okay, I'm gonna analyze in 5 minutes and drop down to the 1 minute. This is not gonna work, okay? If you want to analyze in 15 minutes and drop down to 1 minute, okay, but you cannot do this, okay? You want to skip one. Always you want to skip one, right? Like this. What the fuck? All right, yeah, that's right. Okay, so understanding this, okay, this is the basics for the 5 a.m. model, right? So in the 5 a.m. model, you're gonna mark, let's say this is your 5 a.m. candle right here, okay? I'm gonna put here as 5 a.m. You're gonna drop to the 15-minute time frame. And the 15-minute time frame, what you're gonna look for is a CRT, right? Huge candle number one, weak candle number two, okay, Persian this candle high right here, right? And the distribution candle number three, right? This is basically how the 5 a.m. model works, and like the old school way, okay? And your entry is gonna be like you're gonna enter in the candle number three here. Once you purge this candle high, right? Once you close back inside, let's say here, okay, you have a line, and you close back inside. This is a bearish candle, okay? Once you close back inside of this candle high, okay, you have your entry here, and then you can target this candle low. This is the old-fashioned way to trade the 5 a.m. model used in CRT, right? But if we use that concept of Russian dolls and stuff, and we can improve this trade of 2 risk reward to a trade that's possibly like in the half of this target right here, right? The half of the 5 a.m. target, right? But let's say the double of the risk reward, like you're going to enter here, right? Same stop, and you're going to aim like even even here, like even sooner than this trade, Yeah, can be done. And this is why we use the 1 minute. Okay. So that explains, right? You can use this in a bunch of ways. Okay. You can trade only. Let me put here the 1 minute to not get confused, right? You can trade only the 4 hour here with the 15 minute. Okay. And you can trade only candle number 3 right here. You have candle number 2, candle number 1. You can only trade candle number 3, and it's okay because you have more confirmations, but overall your risk reward is gonna be like worse, right? Or you can skip this one right here and then go straight for the 1 minute. Okay. What's gonna happen? A lot of times you get anticipating the trades, right? So instead of enter here, you're gonna enter like here, right? That's okay. And your target is gonna be sooner also, right? And we're gonna talk about targets and stuff later, right? Not in this video, but we're going to talk about targets, right? But your target is gonna be sooner, and your entry is gonna be sooner also, right? And you think, okay, that's the deal, right? But we have one problem also in the 1 minute, okay? That is the noise, right? The smaller that your time frame is, like the 1 minute, more noise you will have on your charts. So sometimes that you have an entry here in the 1 minute is not really an entry, right? And in the 15 minute, this entry will not show, right? And you will spare a stop, right? Let's say if you have much noise in that day in the 1 minute chart, okay, you'll possibly get like 2 entries right here and you get 2 stops, right? And in the 15 minute, you never had this third candle here. So you never confirm that entry. Therefore, you you spare those 2 stops, right? This is really important because after all, we want to stay our win rate as as much big as we can, right? We don't want to get stopped a lot. But this got more for the risk management, right? But overall, the 1 minute is better. Okay. Yes, sometimes you get more noise. Yes, some days you get stopped out. And in the 15 minute, you will not. But in the other hand, sometimes you get entries in the 1 minute here and you get the target real quickly. And in the 15 minute, you don't get any entry and you're just looking. So in the overall picture, if you're going to compare those two, and believe me, I already did, of course, because this is my job. I need to know, right? I did compare the 15 minute to the 1 minute, and financially talking, okay, the 1 minute is going to be better. Even with more stops, even if more drawdown, the 1 minute pays a lot better than the 15 minute, okay? So if you don't have the balls to trade, to put money on the table, to take risk, okay, go do something else. But this is the way, right? The 1 minute, you're going to have more stops, right? But the risk reward, it's like a lot better. Like it's not impossible to get a 7 or a 8 RR trade here. And in the 15 minute, the max you're gonna get is 2 or at maximum 3, like maximum, right? In the 15 minute, this simply does not exist, right? And in the 1 minute, this exists, it's kind of normal, right? So overall, the 1 minute pays a lot better than the 15 minute, right? So this is the explanation that you can use the 15 minute or the 1 minute. Okay, both work, but the 1 minute, like I said, if you're going to the time frame theory, okay, is going to be the next for the 15 minutes. So you can use the 1 minute and have amazing results also, right? So as this example of yesterday example, right? You see here that we got 1 minute entry. We are currently in the 15-minute time frame right here, right? You have a 1 minute entry right here. that we took and took 4R in this entry, right? But in the 50-minute, we never get this entry because we don't have the confirmation. Like we have candle number 1 theoretically here, candle number 2 closing below. So this is the new candle number 1, right? And we never purge this candle low. So we just stood here watching to the charts and doing nothing. In the other hand, in 1 minute, we got this trade here, got this long and got 4R. So like I said, it's risky, right? But in this case, probably today, we got a one stop right here, right? We spare this stop right here because we don't have the confirmation, right? So this is candle number 1, okay? Candle number 2 closing above. So this is new candle number 1 right here. And you don't have any purge of this candle. So market is still inside of this candle, as you can see, right? So you have no entries in spare one stop. But even get the stop, if I'm the 1 minute, I get 4R here and I get -1 here. So I am positive 3R in those 2 days. And if I'm trading only the 50-minute, I'm gonna be like break even because I did not take a trade here and did not take a trade here also. So 2 days doing nothing, just sitting on the screen. That's not what we want, right? We want much trades as we possibly can because we have bills to pay, right? And doing the proper risk management, it's viable. So it's cool, right? So doing this, we not talk about entry models in depth in this video. Is more to introduce the 5 a.m. model, right? And how can we done the 5 a.m. model, right? Um, so mark the 5 a.m. high, 5 a.m. low, and later of the purge, you're going to have your entry model, right? And we not talk about targets, not talk about entries right here. We only talk about time window that you guys already know, right? 9 a.m. until 11, right? New York time. 5 a.m. candle, you're gonna mark it in the 4-hour chart, right? Highs and lows. And then you're gonna wait for the purge. I'm gonna put a P here for purge, right? And then you got your entry in the 50-minute or the 1 minute as I advise you to do so, right? In the next video, we talk about the entry models, right? And targets and possibly risk management for all this shit and how to approach. All right, then, folks, let's talk about entry models, right? You guys are waiting for. So, just a quick recap here on the 5 a.m. model. Okay, we have this. Well, let's start here. Okay, uh, we have the time window, right? 9 to 11, right? We have the assets, euro, and I'm gonna put an N here because you know GBP, right? 5 a.m. 4-hour candle, right? Mark the highs slash lows. Okay, wait for the purge. I'm gonna put like wait for the purge. Okay, and then entry. And this video is going to be about entry. Okay, so assuming, right, that you already have marked the highs and lows, you're in the correct time window, you're in the correct asset, okay, correct pair. What we're going to do right now is look for entries, right? And entries could be in 2 ways, okay? We have the 15-minute entries, okay? And we have the 1 minute entries, right? And if you ask me, I prefer the 1 minute entries, okay? Because it's always going to be more profitable than the 15-minute entry. So why is the 15-minute entry up here? because it's a more safe play, let's say, right? You can use the 1 minute entry. It's more aggressive, right? Like put this plus here is more aggressive, way more aggressive, right? And you have this 15-minute entry that is like more conservative, right? So here you have more risk reward, you have more trades, you have more money, right? But you also have more stops, right? It's inevitable. You're going to have more stops in the 1 minute, okay? If you don't like stops and you don't care too much about risk reward and stuff, like go for the 15-minute. You're going to have less stops, right? You're going to have less stops, less trades, less drawdown, kind of, because you're gonna make less money than 1 minute, right? But it's totally up to you. Okay, it's totally up to you. So I will start with the 15-minute entries, okay, and then I'm gonna pass to the 1 minute entries, right? So the 15-minute entries, what we want to look for, I'm gonna put here 15-minute entry model, okay, entry models. Is basically when you purge, let's say this is the high and this is the low of the 5 a.m., right? 5 a.m. right here, 5 a.m. You have the high and low right here, okay? When happens to purge right here, what you're going to look, you're going to drop to the 15-minute time frame, okay? And you're going to look for a CRT happening right here. So which means that you're going to look for the candle number 1, candle number 2, right? Like this. And then candle number 3, right? So basically how this works. If you don't know about CRT, here's a quick lesson about CRT. CRT is just an entry model, okay? Candle range theory when you got 3 candles, okay? And the first one is going to be impulsive candle. Is a large, huge candle right here, okay? It's a big candle, right? Needs to be no wicks, okay, or the less wicks possible that you can get, okay. The second candle is going to purge this candle high like this, okay, made a wick, okay, retrace back into this candle range right here, right, close inside of this candle range, right. And this is your confirmation. When you have this candle number 1, like strong candle number 1, okay, you're going to have your candle number 2, right, with almost all times is going to be the like small body and like more large wick up here, right? Purging this candle high and closing inside of this candle range, okay? Your entry is going to be on this third candle right here, okay? So in this case, it's going to be a short, right? So you're going to short here in this candle opening. In the third candle, when the third candle open, okay, you place a short right here since this candle closed inside of the range, right? Your stop is going to be right above, okay, this candle, so a few pips above here, right? And your target always, 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 and this is for the both entry models, right? In the 15-minute or the 1 minute, okay? It's going to be always in the 50% of this range. So you gotta grab your tool, fib tool or whatever. You can use the GAN box as well, where is my GAN box? Right here, okay, right? You have this GAN box you can set up for the 50%, or you can set up your fib tool for 50% also. So you grab this entire range right here, right? The 5 a.m. range. Go to your fib tool, mark the 50% like this. Okay, this is quite messy, but all right. And your target's going to be always in this 50% area right here. Okay. So basically, this is how you're going to approach the 15-minute entries, okay. And some doubts about you guys, I know that you guys have this kind of doubt, right? And it's totally okay. It's about this first candle right here, right? uh Let's say this first candle right here right, did not break the high. This first candle is like this. Okay, and then the second candle comes here and broke the high. Okay, do you guys think this is a valid entry? Think. Okay, this is a valid entry. Okay, since you have the candle number one, okay, you need to have the purge, right? Can be on the candle number one or can be on the candle number two, whatever, right? Doesn't matter. As long as you have this candle number one here, okay, this candle number one with this appearance, okay, needs to look like this, needs to be a candle like this, okay, and you have a purge can be on this candle like this, can be like this, can be like this, whatever, right? Can be like this, right? Like this, no problems. Or you have this candle inside the range, and the candle number two is going to be the purge. It's totally okay, because you have to you need to have those two requirements. Let's say, right? You have to have the candle, and you have to have the purge, right? And the third requirement is this candle number two close inside of the candle range, right? And then you can chart here. Of course, your risk reward is not going to be as good if this candle is move up higher like this, because instead of you took, let's say, a short like this, right, until the 50%, let's say here, this is not the 50%, this is the 50%, okay, let's say here, you're going to have something like this in this scenario. So, right, so as long as this candle moves away, right, you're going to improve your risk reward. But it's an important question here. If you see something like this happening, like this candle here, okay, and this candle here, and another candle here, like this, another candle here, let's say like this. This is not a reversal, okay? You see clear intention and a lot of time spent out here pushing price higher, right? What you want to see is price rejecting this area right here. So you don't want to see price moving up with strength up here, okay? Another candle, 15-minute candle, because remember, this is all 15-minute candles. So it's a lot of time inside here. Another 15-minute impulsive candle, and another 15-minute impulsive candle. This is a clear acceptance through this level right here. Players did not want the price move down. And it's completely different when you have something like this, maybe this, okay? And then you have wicks. Let's say this. Why is not getting bigger? That's what she said. Um, Something like this, and you get rejection right here. This is clearly showing you rejection, right? This is clearly showing rejection. Like price did not wants to go up, is rejecting, right? So yeah, I guess 50-minute entries is covered, right? Let's go for the 1 minute right now, okay? And I'm gonna show in the charts the examples of it, just real quick, okay? So 1 minute entry model, right? You have the same thing here. You have the, oh my God, you have the 5 a.m. range, okay? 5 a.m. high, you have 5 a.m. low, right? This is your range, okay? What's going to happen is now you are in the 1 minute time frame, okay? And I think, like for me, it works best on the 1 minute time frame. I prefer work with the 1 minute time frame, okay? So what you're going to expect, okay, like let's say price is moving up here and doing this shit, and here, like right here, you have your 9 9 9 a.m. clock, right? Time window, okay? And now I have the price doing something like, oh, this is not cool. Something like this. Okay, right, and then push lower, and then come back and like this. Okay, what you want to see in the 1 minute. Okay, let's say this is the 11 and right here. So you want to be inside of this time zone, right? Of course. And what you're going to look for is, first thing, you're going to wait for the purge, like this one also. Okay, you're going to wait for the purge. You don't want to trade if there is no purge. So first thing, you're going to wait for the purge. But this is kind of more simple. You're just going to look for IFG here, IFG, right? Let's say that you have a fair value gap right here in this impulsive flag, right? Let's say this is a bullish fair value gap right here, impulsive, impulsive, impulsive. You have a fair value gap right here, okay? And then you're going to look for this fair value gap to be reversed and becomes an IFG, okay? As soon this IFG has been taken, okay, and the candle close with the body below the IFG in this case, because we're looking for shorts, right? If you look for longs, it's the opposite, okay? But in this case, if the candle close below right here, candle close below, okay, you're going to take your short right here, right? When the candle close out of the IFG, broken the IFG, stop above the high, of course, and target the same, the 50% off. Grab your tool, measure the 50%, okay, and just go for the 50%. It's simple as that, okay? So, practical examples of this. Let me just erase this for not be so much polluted on my chart because I really don't like it. Okay. So this example here, we have this Monday example, right? We have our 5 a.m. range right here. 5 a.m. range, okay? Market's pushing, 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 okay? And we have an inverse fair value gap here, never been taken. Another one here, another one here, another one here, and the last one here, okay? So this is going to be your guidance, okay? Since the market's doing new inverse fair value gaps moving away, okay? The last one is going to be your valid one, right? In this case, we have this inverse fair value gap here that we short, okay? So you can see clearly here, let me zoom in a little bit. You have this inverse fair value gap here, so you get the first candle, second, third, you get this gap right here, you get the fair value gap. In this case, is quite large than should be, okay? But doesn't matter because what you want to see is this bottom right here in this case, right? And since the price closed below it, broken it, okay, you're gonna enter short here, you stop above the high, okay, aiming for the 50%, like this, okay? Okay, so we not talk about that yet, but the amount of trades that you took in the day, right? But in this case, we got stopped out. We make a new structure right here. Remember the structures. We have this lesson, right? The structures. So for this inverse fair value gap here to be valid, it needs to be in a new structure like this. Okay, if you have something like this, and here you have inverse fair value gap, like here, this is not valid. Okay, it needs to be in a new structure. In this case here, okay, this is not valid. Okay, if this inverse fair value gap was like here, in this case right here, okay, sorry, this fair value gap here, this is not valid because it didn't broke above here, okay? Right, so here you have a structure has been broken, create a new inverse fair value gap, wait for the candle close below it. Once the candle close below it, you short, stop above, and aim for the 50%, okay, right here. And here we got, how much? 5.3R. So in this day specifically, okay, in this day specifically, it took a long time. It really took a long time, this trade right here. This is not usual, okay? This is not usual, but it happens, all right? So in this day, we close 4.3% positive, right? That's a lot. So let's see in this case if we have the 15-minute entries. Okay, so we had an example of 1-minute entry. Let's say if we have the 15-minute entry. Okay, and like I said, we do have, okay, and I'm gonna raise this for be more clear. Oh, sorry, no, the 5 a.m. range I will not erase. Okay, we have here, so you have candle number 1 right here. Okay, I'm gonna put this trend line here. I'm gonna make it thicker, right? Candle number 1 here. Not going to mark the low because it doesn't matter for us. Okay, have candle number 1. Candle number 2 didn't purge, so not valid. Candle number 3 close above. If the candle close above, this is not valid anymore. Okay, and your new candle, right? Your new candle number 1 is this big guy here. Okay, so here you have your candle number 1, right? I can mark like this for be more, you know, good for you guys to see it. And then you have your candle number 2, exactly like I said. Okay, candle number 2, purging the high, right? Purging the high of this candle outside of the 5 a.m. range, right? And candle number 3 is going to be your entry. In this case, this distribution candle, right? So what you're going to wait is candle number 2 close inside like this, and then you're going to enter in the opening of the candle number 3 right here. Put your stop above, right? As usual. We almost get stopped out in this trade, right? And then you're going to target the 50% of the leg, okay? Very easy, right? In this case, we also have a better risk reward and we spare a stop, okay? But you're going to see that a lot of days that you get a trade in the 1 minute, this trade didn't happen on the 50 minutes, right? So that's the deal. Sometimes you're going to have the 15-minute trade and the 1 minute trade. In this case, the 15-minute trade is better because we didn't stop out one trade before and we got a better risk reward, right? And the other case, you're going to have the 1 minute trade and the 1 minute time frame trade, right? And you're not going to have the 15-minute time frame trade. So it's up to you, right? Sometimes you get it, sometimes you don't. So it's up to you. In this case, it plays better on the 50-minute, right? But usually in the overall of time, the 1 minute it's more profitable. Okay, but it's up to you completely to choose whatever you're going to use, right? And okay, so I guess we covered all about the entries. Okay, we have those two types of entries, right? And probably the next video we're going to talk about risk management and how to approach the trades with all this concepts that we are discussing for the last few sessions, right? We are in this course for a while now, right? I know it's a lot of content to digest on, and I really want to say thank you guys for being here this far. And it's if you apply everything that I said in these videos, you're going to be profitable as you probably never been, right? So take it seriously. If you need it, rewatch it, right? Um, the full course is here for free, right? But anyway, let's talk about risk management, right? And how to approach the whole strategy. So we already talk about the strategy. I will not cover the strategy in this video again. I will cover the whole risk reward, the whole risk management thing here. So how to approach this, right? Uh, and I gonna give you a set of rules that make it easier for you. Okay. So basically, right, the first thing we need to understand is our target is going to be ever, 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 ever the 50%, right? The technical target is the full 5 a.m., right? But what happens here is, let's say this is a breakout here, okay? So let's say this is a breakout. So we break out here, right? And instead of doing this, right, we just break out here, and then we're gonna move from here, and then here and here, and continue to breaking, right? So in this case, right here, what it means is we put money in our pocket. Let's say we short here, right? Put money in pocket right here, right? So uh, in this case, even if we are wrong, right, in our overall view of the market, right, we still manage to put money on our pockets, right? And this is the goal, right? We don't want to be right all the time, right? We want to be profitable. That's the point, right? So this is why I use the 50%, because most of the times, even if you are wrong, right, you can consider this 50% zone right here as a good place to a pullback, if you want to call it, to a retrace, whatever it is. You This is a good place. So even if we are wrong here, we can continue to push up from here. We put money on our pocket, right? So this is the reason that I use the 50%, because your win rate is going to increase as hell, right? So said that, this is the first point that we need to know, right? The 50%. And I'm gonna cover the example of today's, okay, euro right here and GBP, right? That technically we have the trades, right? We have the trades, but me and the guys in the live room, we don't take the trade, right? Because one simple thing here, right? The risk reward, right? Because you guys know, right? The entry here should be in this candle close, right? Or stop, the correct stop above this high, right? And the target in the 50%. So in this case, you see that you got a negative, right? Negative risk reward. So this is not worth for me, right? And in this case, what I did, and does not work, is once the price close below right here, I put my order on this order block right here, right? My limit order. And in this case, I got almost almost 4 risk reward trade right here instead of 0 point whatever, right? What happens is we didn't retrace so far to get it, and we're just hanging here, right? Same thing with GBP, right? GBP, if you want to trade, the correct entry was here, right? Stop above the high and target here 0.9R. Terrible, terrible risk reward. So I did the same thing. I put my entry right here in the order block and managed to increase this trade to 4 risk reward. But unfortunately, we don't get there as well, right? So this is a point. And why I'm saying this, because this is important, okay? This is part of the risk management, okay? That I do not take trades, right? I'm gonna put an X right here. I do not take trades, right? If the risk reward is less than 2 to 1, right? So if the risk reward here in this operation is lower than 2 to 1, I do not enter the trade, okay? This is my personal risk management, okay? Yours, like, you can be fine accepting, let's say 1 to 1 right here, okay? You can be fine, but for me, it's not worth the trade, right? I really don't want to trade. I really don't want to get into a trade to get only 1 to 1 risk reward. And let's say even if you get this 1 to 1, okay, you still need to discount on this the taxes, commissions, and spread and shits. So this 1 to 1 is going to be like 0.7 R. So for me, it's not worth it, right? But it's up to you. This is my personal risk management, okay? I do not enter trades less than 2-1, right? Everything above here is allowed. Okay, so basically this is the formula that you want to aim, right? If this trade here, let's say in this case scenario right here, the entry, let's say here we got this, this, and this, like the entry was here, let's say, right in this little high right here that we come, right? I'll be taking sure, 2R, yeah, definitely good. But my order in this case was here in this order black, so whatever, right? But in this case, yeah, this 2-1 risk reward here is pretty valid, right? Pretty valid. Cool. This is one thing, right? The other thing, right, is the frequency of those trades, right? Since my minimum risk reward accepted is 2, right? 2-1 risk reward. My maximum frequency of trades for the day is 2 trades, right? So let's say, let me draw here, have 5 a.m., right? Let's say you have the purge right here, right? And then you took an entry right here, okay? Took an entry right here, cool. And then it gets stopped out, right? So that's one, okay? Do the same thing here. Got another entry, right? And got another stop. This is done for me, okay? This is going to be my maximum drawdown in a day, right? I, in any case, will take more than 2 trades in a day, right? This is the thing for me, because the minimum I accept is 2 risk reward, right? So for me to enter a trade, I need at least gain 2, right? And in the worst case scenario, if that trade doesn't pay off, okay, the maximum loss that I accept for that day is going to be 2, right? This makes sense for you guys, because if I aim for at minimum to enter a trade to 2, the maximum I can lose is 2. So let's say if today I get a 2R trade and tomorrow I got 2 stops, okay, I'm break even. I'm at break even, right? No worries about that. So this is my risk management, sorry. And anything above the 2R, it's going to be like a lot of profitable. Let's say the 2R is just the base of the safety spot, you know. This is why I aim for 2R, because it's like my safety spot. If I get 2R, okay, I secure like tomorrow's daily loss, right? If I made more than 2R, let's say I made 4R, I secure tomorrow's daily loss and still have a little bit of fat to work with, right? So let's take this example here in the euro yesterday, right? What happened yesterday is basically, right, we took one stop here, right? One stop, right? Right here. And the other trade that we got right here, okay, we took a win and a big win. We got 7.5R, right? So in this case here, yesterday, we closed in the euro, okay, plus 6.5R positive, right? So this, okay, this allows me to lose 3 days in a row, right, in the euro, and still be profitable because I will up 0.5R, right? So this is the way, okay, to proper risk management, right? So just for recap here, do not take trades, right? If, let's put if here, if risk reward is less than 2-1, right? First rule. Second rule, maximum 2 trades day. Trades day, right? So if you follow those 2 rules, this is pretty basic, guys. This is pretty easy to do, right? Don't overcomplicate this. It's pretty easy to do, right? 2 trades a day, right? And the minimum risk reward is 2 to 1. In the overall, in the long term, you're going to see, you can back test it for yourself. You can forward test it. You can do whatever you want to do, right? You're going to see this is going to be profitable over time, okay? So you need to stick to those rules. This is basically like all the risk management that you should know, right? Just this. If the risk reward is less than 2 to 1, don't take the trade. And maximum 2 trades a day per asset, right? I'm going to put here asset. Asset. Okay? So if you're trading more assets, you need to do the correct position sizer. I'm not gonna talk about position sizer here because the position sizing is personal to each one, right? So maybe I enter 1%, maybe I enter 0.5% in each trade, but it's up to me, it's up to my accounts, it's up to what I'm doing with my accounts, right? So this is basically personal for you, right? But let's say you have only one account, right? And let's say you one account here, and your account's a 100K account, right? CFD account, and you have the maximum loss of this account was maximum loss 10K, right? So this 10K you can enter, if you enter like let's say 0.5% each trade, you need to have 20 trades in a row, like to blow your account, like losing 20 trades in a row to blow your account, right? And honestly, I think this is quite impossible to happen, right? Of course, it will be losing streaks, but you need to proper risk management. And if let's say you get a daily drawdown right here using the same 0.5, right? Your daily drawdown, let's say this is 4 loss because you're trading euro right here and you're trading GBP, not euro GBP, euro and I'm gonna put plus right here, euro. You got a 4 loss in a row. Using this 0.5% here, what you got is 2% drawdown in a day. So pretty easy, right? If you're trading a prop firm account, so 0.5 should be good, right? It takes a little bit more time to pass, but yeah, if you want to use 1%, you're still in the daily drawdown because you're like down 4% if you took daily loss in 2 assets, but your let's say your over life is shorter in those accounts, right? And the time that you have to pass is also shorter. So it's up to you, right? I personally like to use 1% or 0.5% if I want to be more conservative about it. Right, I said that I will not talk about position size, but here we are. All right, guys, I think it's all. You guys know all the drills right now, all the theory, all the practice. You guys know the strategy, the time zones, the assets, everything. Now it's up to you. Put this, back test it, right, forward test it, put in your accounts and trade it daily like a fucking damn robot. Okay? Don't overcomplicate it. Don't overthink. Don't if the setup appears right here, it's fine. Took the trade. If don't took the trade, right? Let's say in this example here, we have the setup, right? But also I didn't take the trade because uh, the risk reward here, you see, 1.3. So yeah, didn't work for me. Didn't take the trade. I tried to take on the retest right here, but not come back. So whatever, not trading this day, right? So pretty easy, guys, right? And with this lesson, I finished the course, right? I hope I can help a lot of you guys, right? I hope you can guys put this into work and see for yourselves. This is really profitable. Really hope that you guys enjoyed the full course, okay? And don't forget it, guys. If you're not into Discord, you can go for Discord, okay? In the Discord, we have the community there. We always changing, ideas and stuff. And you also, if you think you need it, right, you can schedule a one-on-one mentorship with me. That's a small fee per month that I charge, just to keep the channel running and stuffs. So you can just DM me if you want interested in the one-on-one mentorship. Okay, we can work and we can solve your problems, right? And we make you a solid plan, a personal plan for you if you want to trade day trade, swing trade, futures, forex, whatever. We make a personal plan for you, and well, the results of the students has been great so far, so you can check for yourself, right? So if you're interested to get this one-on-one mentorship with me, just enter Discord, DM me. Okay, I will answer you as fast as I possibly can. If you want to join the live room, also join the Discord, go to the live room, join the live room, small fee also. So everything I'm doing for helping you guys. Okay, everything that I possibly can for helping you guys, I'm doing. So make your part, help yourself, and let's get it, guys. Right? Hope you stay well. Big kiss on the heart, guys, and take care. Bye.